All right, well, we'll get started and people can still come in and join us as we're going along. Welcome to CCI National first webinar for 2021. Today we are going to be talking about financial statements, and we've got a great panel of speakers from across the country that are going to help translate those numbers for you. My name is Sonia Hodes. I'm a condo lawyer and a director on the CCI Huronia Board of Directors, as well as the co-chair for the CCI National Events Committee, and I'm going to be your moderator today. Whether you're an owner, a director, a property manager, at some point in the year, or maybe even once a month, you're going to need to look at the financial statements and understand what they mean. So do you really understand what those numbers are telling you, and do you know what questions to be asking? Our goal today is to have you walk away from this webinar being able to answer yes to both of those questions. So we have speakers representing various CCI chapters from across the country. We've got John Popovich from CCI Manitoba. He's a client service manager with Lazar Grant LLP, the vice president of the Manitoba chapter, and the treasurer of his own condo board. We have Tracy Wright from CCI Nova Scotia. She is a chartered accountant and has been involved with the audits of condos for the past 25 years. From Eastern Ontario, we have Tuan Lee. He is also an accountant and he has worked with condominium corporations in Ontario. And finally, but not least, we have Walter Wakula, who is from our CCI South Alberta chapter, and he is a condo director and treasurer for CCI South Alberta. He also has over 30 years of experience of senior management and corporate director experience. So while we may not be in the same room or even in the same province, we are still connected coast to coast today, as CCI is your condo connection. And we're going to start off with a poll to find out where our audience is from. So I'm going to launch the poll right now. And if you could just take a minute to click what province you're from. Looks like we have somebody at least from almost every province except PEI and Quebec. And I'm going to close the poll in 5 seconds. So if you'd like to identify what province you're from, please do so. All right, I'm going to end the poll and I'm going to share the results. And 56% of our participants are from Ontario, followed by Alberta and Saskatchewan, being the second and third highest in participation. So thank you, everyone, and welcome from across the country. So who is the Canadian Condominium Institute? Well, we're an independent nonprofit organization that was formed in 1982, and CCI's main objective is education. However, we also advocate for condominiums and stratas and the condo strata industry in general. We represent all of those involved in condos and stratas, from owners to directors to professionals, and we encourage all of these stakeholders to work together. One of CCI's main assets is that we have access to a variety of professionals, owners, and condo strata directors from coast to coast, as we are the only national condominium strata organization. If you're not a member of CCI and you want to experience the benefits of membership, make sure to check out one of your local chapters. And Andre Ball, who is on the CCI National Executive and is helping me out today, she's going to be posting in the chat box links where you can find out where your local chapter is. The CCI National website is cci.ca, and there's a lot of other great information on that website that you may want to check out. We do have a resource center that is available. That can be found on our website as well. You can also find out about all of the upcoming events, not just at the national level with our webinars and conferences, but also what other chapters are presenting on, and you can get a direct link to those webinars to register there. So cci.ca is our national website. Lots of information if you're in a condo or strata. Also, our national webinars are being recorded, and today's webinar is being recorded, and that will be available in our resource center next week. If you missed our webinars from last year, that was our insurance webinar and our COVID-19 webinar. If you just go to the resource center, you can find the recordings for those webinars there. So before we get started, there's just a couple things that I'd like to remind everybody about. One, please, if you haven't had a chance to download the handout, it is available on the website. If you just go to the upcoming events and click on today's event, There is a download handout button. Andre's going to put a link in the chat box as well, so that if you haven't downloaded it, you can download it. We are going to be looking at financial statements, and sometimes those numbers are small and it's hard to see it on a screen, especially if you're watching on your phone. So you have the ability to actually download these statements and look at them either on a bigger screen or print them. We will be taking questions live at the end of the webinar. So if you're interested in asking a question live, you just raise your hand. And you can do that if you open up the participant box. You'll see a raise your hand feature. If you're calling in on the phone, you can do that by pressing *9. We have also received some questions in advance, and we're going to try and address those. And the other way you can ask questions, if you don't want to ask them live, is to open the Q&A box, which you'll find on your screen, and you can type your question in there. The panelists are going to try and answer those questions as we go along. And if we can't get them answered during the webinar, we'll try and get them answered at the end of the webinar. And then finally, the chat box is open, but please don't post any questions there. We're not going to be answering any questions in the chat box. This is where Andre is going to be putting links and information about our speakers. And also, if you have any problems, you can send Andre a chat privately, and she'll try and help you through those problems. And I definitely want to make sure that we take time today to thank our sponsors. Without our sponsors, we're not able to offer these webinars free of charge. So thank you very much to our sponsors. And you would have seen them when you came in. But I also just want to make sure we give them the proper recognition. So thank you to our sponsors, Aaliyah Associates, Bridges Property Management, BFL Canada, Condo Genie, and Metro Jet Wash. So once again, thank you, and feel free to check them out on the website. There are links directly to their websites if you click on their logos. And then finally, before we get started, our disclaimer: the information that you are being provided today is general information, and things are changing fast. So what you need to do in your specific situation is very fact specific. It is more important than ever that condos rely on their professionals for advice. And so if you hear information today, it may not be relevant in your province. So please check with your provincial professionals to make sure that the information is correct for your specific situation. In addition, the information provided in today's webinar is current as of April 14th, 2021. For those that are watching this webinar after today's date, again, please make sure that the information that you're receiving through the webinar is still current and applicable to your situation at a future date. And also, please be advised that references to legislation by a speaker may not be specific to legislation in your province. And once again, it's very important that you contact your local provincial professionals. So without further ado, because we've got lots to talk about today, we're going to get started, and John, you're going to start us off with budgets. John?
Yes, I'm here. Thank you, Sonia, and welcome everyone. I hope the weather is better in your part of the country. Here in Manitoba, it's been snowing since Monday, and we have accumulated around 20 centimeters of snow. It's quite a shock after the spring weather we had earlier. As Sonia mentioned, my name is John Popowich, and I've been an accountant for all of my adult life. And before my colleagues get into the components of financial statements, I'm going to speak briefly on budgets. So do we need a budget? Well, the short answer is yes. While it's not necessarily required, it is the best way to help manage finances and ensure the corporation has the funds to cover expenses. Budgets usually appear on the annual financial statements for comparative purposes. And first, I'm going to give you a little history of my involvement with my own condo corporation. My condo corporation is self-managed. When I first bought my condo and attended my first annual meeting, I found that the board at that time did not prepare a budget and did not have a reserve fund. I was elected to the board a few years later and found that there was no plan to address future repairs, and the board was not willing to address it. Go ahead a few more years, and with numerous changes to our board, I was appointed treasurer, and along with the new board, we began to address the problems we encountered. I prepared a preliminary budget, and the board set up a reserve fund bank account. We still did not know what needed to be done and how much money we should have in our reserve account. In 2016, we had our first reserve fund study, and using this study, I prepared a preliminary budget and presented it to our board for review and discussion. After some lengthy discussions and tweaks to the budget, we realized that we would not have enough money to carry out the required work to our condo buildings. Faced with the decision of implementing a special assessment, which wasn't favorable, we decided to have a 2-year surcharge of approximately 59% to cover the work to be done. And after 2 years, we would revert to our original fees plus 2%. Without a budget, we would not have been able to come up with the plan we did. While most of our owners were not happy about the increase, they were thankful for not having a special assessment, and as we provided them with a copy of the budget, they understood the need for what we did. So what is a budget? A budget is an estimate of the money coming in and going out for the year. It is not exact. It is your best guess as to what will happen over the coming year. Without a budget, the board will not be sure if they have the funds to cover the expenses over the coming year. It also gives unit owners an idea of where the money will be spent. A budget is prepared annually and does not require the vote of the owners. I personally prepare a 5-year budget so we have an idea of what we can expect to happen over the next 5 years. The board reviews and updates the budget every year. So how do we prepare a budget? Well, if you have a property manager, they may be the ones who prepare your budget. But regardless, the board should have input into what is in the budget and should review and approve the budget. You start with all the known revenues and expenses, usually from the prior year financial statements, and enter your current year expected revenue from all sources, common area costs, parking, etc. Enter all the known operating expenses, and if you know of any unusual coming up, enter those. Enter all your expected reserve fund expenses, usually obtained from the reserve fund study, and that will give you a preliminary budget. From there, I take the preliminary budget to a board meeting and review it with the other board members. We can make changes if necessary and add anything on our wish list that may not be on the reserve study. And once all the numbers are entered, we can see if we have a surplus or a shortfall. If we have a shortfall, we may have to raise condo fees, have a special assessment, or eliminate expenses that we deem not necessary. A copy of the approved budget is sent to all the unit owners. Included in your package is a sample 5-year budget, and I'll focus on this budget. The top half is the operating fund, where the everyday expenses are paid from the condo fees. In this case, the corporation expects to collect $750,000 in condo fees and $7,500 in parking fees, and they expect to transfer $175,000 to the reserve fund. After their operating expenses, they expect to generate a $10,000 surplus. Having a surplus isn't always necessary, however. You can operate a budget with a deficit, particularly if you've had a surplus in the previous years. In this example, a deficit in 2021 could occur because a surplus was achieved in 2020. These numbers, as I said previously, are estimates and need to be compared to the actual numbers on the financial statement at the end of the year to determine if that surplus was realized. If a deficit does occur, the board will need to consider options such as increasing condo fees, special assessments, trimming some expenses if possible, or lowering the amount transferred to the reserve. The middle section of the budget you see is the reserve fund. Again, showing the transfer in from the operating fund and any interest expected to be earned. I apologize that as the headings here are not correct. It should be 2020, 2021, and so on. That was a typo. All expected reserve fund expenses are listed, and in this case, a $60,000 surplus is generated. As you can see, they had a surplus from prior years of $290,000, leaving them with a combined surplus of $350,000. Again, if a deficit does occur, the board will have to consider the same options as in the operating fund. Quite possibly, they may carry on with small deficits. However, they may be short on the required balance as per the reserve fund study. The bottom section compares the reserve fund balance against the required balance per the reserve fund study. And this is quite important. Here, they are $37,000 above the required balance and are in a good position going forward, being above the reserve fund study balance. This gives them a cushion should anything unusual happen in coming years. Again, as the budget is an estimate and prepared prior to any monies being expended, it needs to be compared to the actual numbers. And then the remaining years maybe need to be adjusted to reflect any changes. So that concludes my brief presentation on budgets, and I'll pass it back to Sonia now to continue with the financial statement presentations.
Great, thank you. Thanks, John. So now we're going to move on, and Tracy is going to talk to us about balance sheets.
Hi, everybody. My name is Tracy Wright. I'm from Nova Scotia. So we don't have snow here, thank goodness. So yes, I'm on board to walk you through a balance sheet today, which I believe was in the handout that Sonia will put up on the screen. So condominium corporations are not-for-profit organizations, and as such, they follow the Canadian accounting standards for not-for-profit organizations. So these standards say that the financial statements, at least your annual statements, have to be prepared on an accrual basis versus a cash basis, which means that transactions are reflected in the financial statements in the time period they relate to, as opposed to when the transactions flow through your bank account. So for example, condo fees would be recorded when they're owed at the beginning of the month, not when they're collected, and expenses are recorded when they're incurred rather than when they are paid. So the statement of financial position, that's just another word for a balance sheet. It's just a terminology that's used for MPO. So a balance sheet balances because our assets always have to equal our liabilities and our fund balances. So what a balance sheet is, it's basically a snapshot in time, and in this report, that snapshot in time is as of December 31st, 2020, of what the corporation has for assets, liabilities, and fund balances. So many condominium corporations follow fund accounting, which is why you see so many columns on this statement. So each fund is represented by one of those columns. So we have a general fund, we have a reserve fund, and we have a contingency fund. So the general fund is the fund that collects all the condominium fees and pays for all of the normal day-to-day routine expenses of the condominium corporation. The reserve fund are monies that are being set aside for future major repairs and replacements. And then we have a contingency fund, which are monies that can be used for unforeseen or unbudgeted expenses or deficits that may arise. So I'm just going to walk you through, this balance sheet or statement of financial position captures traditionally most items that you would see on a condominium set of financial statements. So I'm just going to go line by line and describe what all these different amounts represent. So first we'll start off with assets. So assets are resources or items of value that the corporation owns. So common examples. So first we have, the first line item is cash. So we have total cash resources of $79,000. So that actually is what you would think it is. It's money that is sitting in your corporation's bank account at any point in time. So if you sit on the board, you want to make sure that those balances that are reflected in the accounting records have been reconciled back to the actual banking documents. Receivables of $3,500. These are amounts to the corporation, and it could be for lots of different things. If someone hadn't paid their condo fees, it would sit on the books as an accounts receivable until they were received. Sometimes there are chargebacks to unit owners if an expense arises that is deemed to be the responsibility of a unit owner. Then those funds have to be received back by the corporation. Or sometimes there are rebates that you can receive. In my province, you can get an energy rebate for a portion of the sales tax that you pay on utility costs. So again, that would be a receivable on the books of the corporation. So as a director, when you're looking at financial statements, you want to look to see who owes you money, why they owe you money, and have you collected it after the fact. An interfund balance. So you'll see that nets out to zero in the total column, but a lot of times that represents monies that are owed between some of the funds. So it could be a transfer to the reserve fund that hasn't been made yet, or an expense that's been paid by one fund, but it's been paid on behalf of another fund. Investments on the books of $365,000. So many condominium corporations will invest their reserve funds in GICs or other interest-bearing type instruments to generate some return on those funds, rather than just allowing them to sit in a bank account and not generating any kind of return. Those would be reflected in the financial statements of the corporation at their cost plus any accrued interest. Prepaid expenses of $2,500. So prepaids represent expenses that have been incurred, a portion of which relates to a future time period. So insurance is a great example of this. So if you have a December 31st year end, as we do in this scenario, but your insurance policy runs from February 1st to February 1st of each year, at December 31st, you would have technically prepaid 1 month of insurance, representing the month of January. Other common expense examples of prepaids would be service contracts, where maybe they're billed on a quarterly basis and that quarterly period doesn't coincide with your fiscal year end. So those are current assets. So those are assets, we call them current because they're expected to be realized within the next 12 months from operations. Then we have capital assets, which would be considered a long-term asset. So capital assets, this is where condominium corporations are a little bit unique. So capital assets that are directly associated with the common elements of the corporation are not reflected on the books of the condo corp because they are all owned proportionately by each unit owner. Capital assets would only be recorded if the corporation paid for the asset, has title to the asset, and either can dispose of it or use it to generate cash flows for the corporation. So in this example, the capital asset that's recorded in this balance sheet is the superintendent's unit. So the condominium corporation actually purchased that unit from the developer and paid $200,000 for it. So it sits on the books of the corporation. So that's it from an asset perspective. And we move down to liabilities. So I think we all have the joy of knowing what a liability is. So these are obligations that require an outlay of cash or the reduction of an asset. So we have a couple of different categories that we would normally see on the balance sheet. So our payables and accruals of $13,300, these are really just comprised of our day-to-day operating expenses, where the good or the service was provided to the corporation, but we didn't actually pay the supplier until after the end of the year. So our utilities are a great example of this. So we are provided electricity and water for the month of December, but we don't pay the utility until January of the following month. Current portion of long-term debt of $10,000 and long-term debt of $140,000. So this is basically, in this example, a mortgage. So when the corporation purchased the superintendent unit from the developer, they also obtained a mortgage that is secured by the unit. So we break them out between a current and long-term portion, with the current portion representing how much the debt will be repaid during the next fiscal year should all the scheduled repayments be made. So that's it for liabilities. And then our last category are fund balances. So this is really the equity of your corporation, or what's left over at the end of the day when you deduct your liabilities from your assets. So we have equity in our general fund of $72,700. And we've broken this into two different categories. We have an investment in capital assets of $50,000 and unrestricted of $22,700. The investment in capital assets of $50,000 represents the equity in the capital assets and is equal to our capital asset value up top in assets of $200,000, less the current portion of long-term debt of $10,000 and the long-term portion of $140,000. That's how we calculate the $50,000. Our unrestricted equity of $22,700 is the accumulation of all of the operating surpluses and deficits since the very first day of operations of the condominium corporation. The equity in our reserve fund is $404,000. So again, this is all of the unspent equity that you've accumulated for future major repairs and replacements. And this is the value that we would be using to compare that to what our study says we should have in our fund at any point in time. Our contingency fund also has equity in this example of $10,000. And again, this amount can be used for unforeseen expenditures or debt rise. So that's our balance sheet.
Thanks, Tracy. All right, so we've talked about budgets, we've talked about balance sheets. Let's now move on to Walter, who is going to talk to us about income statements. So Walter, you want to get us started?
Sure thing. Thank you, Sonia, and welcome everybody. It's amazing how many people are attending this. So I will be explaining an income statement. And income statements are known by quite a few different names. They're called profit and loss statements in some sectors in Nova Scotia. And as Tracy showed us, it's a statement of general revenue, expenses or expenditures, and fund balance. In Alberta, they're called statement of operations and operating fund deficiency. And I'm sure in other provinces, they're called other things. But basically what an income statement is a listing of revenues and expenses. And when you take, the expenses, the total of the expenses away from the revenues, you end up with what's called a net income or a net loss. Sometimes it's called a profit, so there's different names for these different terms. In some cases, there are statements that will cover, let's say management statements. Others are year-end formal accounting statements, financial statements. I thought I'd start with this slide here, which is kind of the very simple condominium corporation, because not knowing the financial knowledge of over 500 participants, I wanted to keep it simple to begin with. I'll make it more complicated later. So revenues are the good things. That is basically cash coming in, and that's for condo fees, guest suite revenues, interest income. Let's stay back there, please, and so forth. Expenses, are bad things but necessary things, and these are the expenses. These are the cash going out pays for the administration, the utilities, the insurance, the repair and maintenance, and all the other aspects of maintaining your corporation. Now, the net income or loss is the difference between the two. So it can be a good thing, a positive, which is what you want to get, or it can be a bad thing, where you're short of cash, for the year. And then a surplus or deficiency, this is the sum total, just as Tracy had said, it's repeated on the balance sheet. This is the sum total of the cumulative profits, less the cumulative losses that the corporation has sustained since its inception. And you want that to be a positive, a plus cash number. So just to demonstrate, the different, I forgot a couple of things here. The income statement covers a period of time. The period of time, for formal statements, a formal income statement is typically 1 year, but income statements can be 1 month, 3 months. Those are typical, but typically not longer than a year. They can cover the current time period and previous time periods, as you'll see later. And there are management statements, what I'll call the management board statements, that are typically produced monthly for the management of the corporation. And then there are the annual statements or quarterly statements, which typically go to stakeholders and to owners to tell people, what's going on in a more formal, independent way, at the end of a period. Okay, next slide, please. Now, I'm not going to go through this very busy slide. I just wanted to get the slide up there to show you that we went from the very simple statement that I started with to this, which is what a typical board of directors will get, from either their bookkeeper or their property manager, every month. And it's got, as you can see, under revenues, it's got a number of different accounts. Under expenses, again, a large number of accounts. And the reason for that is if you're managing the corporation, you want to be able to see, where the money has gone and where the money is coming from, in order to manage the amount during the year that let's say manage the finances of the corporation. The current month actual, the current month budget, year-to-date actual, year-to-date budget, and so forth, and also the variances, so that directors or the manager can, or both, can look to see how things are going in all the different accounts. Next slide, please. And the next one, please. Yes, the next one.
Oops, sorry there.
Now, this would be a typical annual income statement, and as you can see at the top, I had said that that they come with different names. What we've got here is what I call Messy Condominium Corporation, and Messy Condominium Corporation is let's say a condo that has got a lot of problems. If you see an income statement like this, don't buy a unit there and don't go on to their board. So the reason for putting it up there is with the bolded numbers on the right is just to point out the key things that we should be looking for in in an income statement. We start with number one on the bottom right-hand side. One of the first things to look for in an income statement is, did they run, have they got an operating surplus or a deficiency? You can see here that for the prior year they had a deficiency of $9,400, and it got worse. In the latest year, being reported at a little more than $24,000. That is an untenable financial situation. Should never be negative. And if we look at the down below to the left there under operating fund target, that should be in this case at assuming 3 months worth of expenses, a financial cushion. The target there should be about $31,000. So Messy Corporation is way short, of that. Then if we look at number two, up near the top, we can see in the prior year that Messy had a special assessment of $45,000. And even with the special assessment, we go to the bottom and we see they're still running a very large deficiency, even though they had a profit of $24,000 and change. But that didn't even offset the amount of the special assessment. Looking at number three, we see that there's a transfer of approximately $21,000 to the operating fund from the reserve fund. In Alberta, that's an illegal transfer. Once money is set aside in the reserve fund, you cannot move it back unless there is an emergency, a declared emergency, either provincially or nationally, where you're allowed to temporarily move those funds. So that's another red flag. The fact that that money was moved there, and even with moving money into, you can see this corporation is scrambling. First of all, it's got a deficiency in its operating fund, and even with special assessments and the deficiency, if we go up on the right-hand side and look at number 4, the condo fees are the same, and they budgeted for the same. Red flag. This outfit has got financial problems, and they don't want to raise condo fees. I put number 5 in there primarily for the property managers that are with us today, because you got to wonder, how did these guys get into this mess? And my property manager friends tell me, well, wait a minute, they didn't spend anything, the prior year, so of course they've got a mess. But then they only budgeted $3,000 for it in the current year, and then still had to spend $12,000 and didn't get themselves out of a mess. Number 6 is, and also number 5 has the legal fees. Red flag to look for. If legal fees suddenly jump, as they have over here, there are some legal problems. So another thing to watch out for. Take a look at what's going on with the corporation's legal fees. Looking at number 6, we can see building repairs and maintenance. In this case, there is a huge increase. The prior year amount of that was spent was about 22,000 and change. Then they budgeted less than that for the current year, and then virtually doubled the amount of the amount that they spent on building repairs and maintenance. The red flag there is not so much the amounts. The red flag is, does the board know why the amount went up by that amount? And if it doesn't, that's where the problem is. That, in a nutshell, is income statement, Sonia.
Well, thank you, Walter. And that last sheet, there's a lot of great tips, that 1 to 6 of things to look out for. All right, so let's move on to reserve funds. And Tuan, you're going to be talking about reserve funds and the statements with respect to them. So why don't you get us started, and then I'll put up the screen with the handout.
Great, thank you very much, Sonia. Thank you everyone for signing up and logging on to listen us babble. All right, so I will be looking or reviewing the Statement of Reserve Fund Operations and Fund Balance. Just like my fellow panelists have said, the statements can be called different things in the various provinces. So we'll take a look at the reserve fund here that's presented. So we have 3 columns, just waiting for it to come up. There we go. All right, so you see the Statement of Reserve Fund Operations. So so you have 3 columns. Just like Tracy said, the Statement of Reserve Fund Operations is recorded on the accrual basis and not the cash basis. So basically, receipts or revenues that are earned are recorded as revenue, regardless of when they're received, and expenses are recorded as expenses when they're incurred rather than when they're paid. All right, so 3 columns. The plan column you see there on the left. In Ontario, our act basically states that the auditor or the accountant should be comparing the reserve fund study with the reserve fund within the corporation. And some firms in our province will choose to show this information qualitatively in the note disclosures to the financial statements. This presentation that you see is typically our presentation, where we actually lay out the plan column, the figures from the reserve fund study. So you're able to see or compare the figures on the study versus the current year. So you have the plan column, you have the 2020 column, which is the current year, and then the 2019 column, which is the comparative or the previous year. Now, if we go back, so for new condos, so newly registered, declared condos, you would see 2 columns, would be the plan and then the current year. However, this condo is a little more mature, so it has a comparative figure. So we'll take a look at the 2020 column, the middle column there. Owner's contribution, so 175,000. That is the reserve fund allocation that was planned by the reserve fund study, or in our province, Ontario. There's also something called the Form 15, the funding plan, that's laid out by the board to basically budget and plan for contributing to the reserve fund from the general or the operating fund. So that's the 175,000. And then there's the interest revenue for 1,000. That basically can come from your bank account, your reserve bank account, or any investments. And I was scrolling through and I was seeing some of the questions that were being asked, and I saw a question about what type of investments can be purchased. So we'll touch on that later on in the webinar. So that gives you total revenue just for the reserve fund of $179,000. And then the next section are expenditures, so the expenses. So in this condo, the expenses that were incurred, whether they were paid or not, but they were incurred by December 31st, 2020. So if a supplier has given the corporation or supplied the corporation with goods or services by December 31st, the expense has to be incurred in there, and whatever portion that is recorded, even though it has been paid, will be recorded as an accounts payable on the balance sheet or the statement of financial position, as Tracy had outlined. So here we have the three expenses totaling $100,000, giving you an excess of revenue over expenditures, approximately $79,000. At the beginning of the year, the reserve fund had $300,000. So at the beginning of the year, basically the equity or the fund balance, the net assets of the reserve fund was $300,000. And then a little special case in this condo is that in addition to the $175,000 of the owner's contribution that was budgeted and planned for and done in the year that we saw above, this corporation decided that, well, hey, looks like we have, an excess or a surplus in the general or the operating fund. And so therefore they've decided, or the board has approved, an additional $25,000 transfer from the operating fund, therefore giving you a reserve fund end of year balance of $404,000, which is its equity or its fund balance or net asset. Just a note there, just going back to quickly, the owner's contribution, $175,000, as I said, because of the accrual basis, in the year when the budget, the operating budget and the reserve fund study calls for $175,000 transfer from the operating fund to the reserve fund, it's recorded as such. However, in this condo, if we can go back to the statement of financial position, you will have seen, if you remember, an inter-fund balance of $25,000. It's the statement that Tracy, there we go, that's it. All right, so if you look at the assets section, 3 lines down, inter-fund balance, you see general fund negative 25 and then reserve fund 25,000. That means that of the $175,000 that was recorded as a transfer from the operating fund to the reserve fund, in reality, only $150,000 was transferred physically, therefore leaving an inter-fund balance of $25,000. And just to quickly answer some of your questions there, that $25,000 is purely just because the general fund had not transferred enough of that 175 over in the year, and not necessarily the general fund, getting a loan from the reserve fund or anything like that. Because as Walter mentioned, once it goes into the reserve fund from the operating fund, it cannot go back unless there's an emergency. All right, so just quickly back to the statement of reserve fund. There we go. Okay, so next one. So statement of reserve fund. Okay, so there we go. So the 2020 column, the 404,000, that figure, you don't need to go back, but you will see that figure on the statement of financial position as the net asset figure in the equity column. All right, so this is the statement of reserve fund operations. Now, our Condo Act in Ontario also shows or allows for multiple reserve funds to be established. So if we go down to the next page, you will see a contingency fund. You basically can have as many reserve funds as you need in order to, I guess, properly segregate so that you can properly understand whatever projects you might have going. So in this case, this corporation has established a contingency fund, and the 5,000 has been transferred or allocated from the general fund that we saw previously presented. So there are condos that we've seen that whether they have shared reserve funds, so shared facilities reserve funds, but they will also have a second or even a third reserve fund study. And at that point, you can potentially also present the subsequent reserve fund studies on the statements of the other reserve funds as well. All right, so after the reserve fund, if we scroll down, we should see the statement of cash flows. So up until probably about 10, 15 years ago, our institute did not require us to present a statement of cash flows, because in our opinion, it often gets more questions than the information it shows. However, the statement of cash flows basically gives you information about the cash activity in the year, so that would allow the board of directors a little bit more information to properly manage their actual cash flow in order to not have any shortfalls in their accounts. So the statement of cash flows, unlike the statement of financial position and the operating statement for the general and the reserve fund, is on the cash basis. So that means net income in your general fund or your operating fund and your reserve funds doesn't necessarily mean, or at least cash, it doesn't necessarily mean it's cash. All right, so we take a look here. There's 2 columns, 2020. So you will always have, well, not always, but at most you will have 3 sections to your statement of cash flows, the operating activities, basically, and this is for both the operating and the reserve funds. So this is where you will record the actual cash inflow and outflow of your condo fees, your expenses, whether they be utilities, repairs, maintenance, reserve fund expenses. That's where you would see those cash flows in the operating activities. The financing activities, the second section there, is where you would typically see bank loans. If your corporation needs a bank loan to fund a project. And then the third section is the investing activities. And this section basically would be where you typically see purchase of investments or capital assets. So after that third section, you see the increase or decrease. In this case, it's a decrease in cash. So there, in the year, this means that $266,000 more cash left of the 2 bank accounts than went in. At the beginning of the year, this corporation had $345,000 in cash. Therefore, at the end of the year, this corporation had $79,000 in cash, and that $79,000 is segregated out to the 3 bank accounts, and you see that in the very last section represented by there, and you can see that $79,000. All right, so that concludes my presentation of the reserve fund statement and the statement of flows.
Thanks, Twan. So Tracy and John and Walter and Twan, they've taken us through sort of the basics of the statements. And before we get into our question and answer periods, we wanted to make sure we had left lots of time for you to be able to ask your questions. I'm going to be asking each of our panelists to provide us with their tip that they'd like to sort of leave us with. But before I do that, I just want to remind everybody that you can ask questions in the Q&A. I've noticed we've already had almost 50 questions answered in the Q&A box. So thank you to our panelists for going in there and answering those questions as we've been doing the presentation. So feel free to still keep putting questions in there. And also, don't forget that you can raise your hand as soon as we open the live question period, and we'll be taking questions live from the audience. So going back to our tips, Why don't we start with you, John, because you started us off today. What's the tip that you would leave our viewers with?
Well, there's a couple things with budgets. Number one, I would be very realistic in preparing a budget. Don't try and make it come to zero. If your expenses are going to exceed your revenue, that's what you put in your budget so you know. And also constantly review your budget. We try and review ours at least in general at every board meeting.
Thanks, John. Tracy, what tip will you leave us with?
Sorry, I was muted. My tip would be that if you're a self-managed condo corp and you're struggling with your finances or your bookkeeping, I have a lot of self-managed condo corps that actually outsource the accounting function to a bookkeeper. So I find that very useful. If there's no one on the board that really knows how to do bookkeeping, it alleviates the stress from that. But it also introduces an independent party who's now also going to be another level of checks and balances as to what's going on with the condominium's finances. And just to ask questions, they're your financial statements, so make sure that you understand them, and there are no stupid questions. So make sure that you ask until you do get that thorough understanding.
Thanks, Tracy, and thanks for mentioning that tip for self-managed condos, because we do have a lot of self-managed condo stratas across the country, and that was a great tip out to them. Walter, what's your tip?
I'm very I'm a big advocate of what you would call a financial cushion in the operating account. I think, and what that means is that your operating fund surplus, should be at at some positive level that will allow you, to be able to weather any unusual circumstances, during the year. As an example, we've just all, I think, seen the huge increase in insurance premiums, and in order to pay for that, typically, you have to pay it in 3 installments for the whole year. So where are you going to get the money from in order to do that? And other examples are under COVID, for example, a lot of condo corporations in Alberta, for example, had revenue decreases, significant revenue decreases as people couldn't pay, their condo fees, So again, financial cushion. And a rule of thumb that I use, and I don't know for sure if it's best practice, but I'm trying to make it best practice in Alberta, is that you have at least 3 months worth of expenses sitting in your operating fund surplus.
Thanks, Walter. It's always nice to have that little bit of a cushion. Antoine, what's your tip?
My tip would be when the manager and the board get together with the engineers to start preparing the reserve fund study, to use the correct number as the starting balance of the reserve fund balance in the reserve fund study. And that correct number is the net asset number. So basically, assets less any liabilities in the reserve fund equals your net asset or your equity or your fund balance. Use that last number. I have seen in a handful of situations where a condo has used just the asset, so basically either just the cash and or investments, and have omitted the liability. And so the reserve fund balance, the opening balance, ends up starting out with a much lower balance. Much higher balance than what it really is, had the liabilities been included. And that would be a huge shortfall to then make up in subsequent years. So that would be my tip.
Okay, thanks, Tuan. All right, so we're going to open up live questions now. So if you have a question, you can raise your hand by just opening the participant box and pressing that hand button. We do have some people participating by phone. You can still raise your hand by just pressing *9 on your phone. And what's going to happen is Andre is going to bring you into the panelist room with us and unmute you, and you'll be able to answer or ask your question live, and we'll have one of the panelists or a couple of the panelists answer your question. So Andre, do we have anybody that's asking questions live?
We have Evelyn. Evelyn, if you want to unmute yourself.
Thank you. Okay, this all went really fast and I've really enjoyed it. Very, very useful. Could you just again explain what the unrestricted amount is of 22,700 on the condominium statement of financial position?
Sure. So what that 22,000 represents is it's the accumulation of all of your surpluses and deficits in your general fund from the very first day up since inception of the condominium corporation. So if you compared all of your condo fees against all of your general fund expenses from the very first day, you had a net surplus of 22,700.
Thank you.
You're welcome.
Thanks, Evelyn, for your question. And don't worry, if it felt fast today, you're going to be able to watch a recording next week. So you can always go back and watch it again and take it a little bit slower and take some notes. All right, Andre, do we have another question?
We have Catherine. Moment. Catherine, you can unmute yourself.
Sorry, I was just out and now I'm back in. So I had a question about accrual. So if I've had some work done in December, but the invoice doesn't come in till January, which year does that get reported in?
What's your year
December.
end?
A year end being December 31st.
Yep. So it gets reported in December.
So even though I haven't had the invoice yet.
Correct.
Okay.
Yep. So a service has been provided. It's similar to if a situation happened that created an obligation that you knew you had to incur a cost relating to it, that also would be accrued.
Okay. Thank you.
You're
Also,
welcome.
if I could add to that, I know with reserve fund expenses, a lot of the times when it's a large project, windows, roof, paving, the supplier will also have a 10% holdback. And what we find is a lot of clients, most firms will not record that as an accrual at year end. So part of the audit will come in and will record the holdback for each invoice, the various phases or the billing numbers from the supplier. And sometimes that could be tens of thousands, hundreds of thousands of dollars, and that really shocks the board. So just keep that in mind with significant reserve fund expenses, that the holdbacks for the work that's been done up to the year end needs to be recorded as well.
All right, thanks. Andre, while you line up the next live question, I'm going to put a question out there that's in the Q&A box that hasn't been answered, and I think it's a good one. Kazan says, I find accounting is not proactive but reactive. What proactive things can be done? And Walter, maybe we'll start with you.
Well, I think where you get proactive is with the budget. And one thing I noticed with John's budget, which I haven't seen actually, is a 5-year budget. Typically, you only see 1-year budget. So if you want to be proactive, if you're thinking 1 year out or 2 or 3 year or more years out, you are being proactive. On the reserve fund, with the reserve fund, similarly, typically we only focus on the first 5 years, really focus on it because that's where you have to plan, in order to get those projects done. But how proactive can you get when you've got a 30-year plan in front of you? So I guess that would be my comments on proactivity. If I'm understanding the question correctly.
John, do you have anything to add into that about what condo stratas could do to be proactive? Oh, you're on mute, John.
Sorry, I was just answering a question in the Q&A, but no, I agree with what Walter said. Being proactive is looking ahead and anticipating what's going to happen in the future, and that's part of the reason that we do a 5-year budget. We want to know what's happening 5 years from now, or what we anticipate to happen 5 years from now, rather than just what's happening this year or next year.
Tracy or
Yeah.
Tuan, do you have anything to add?
Yeah, I'd like to do a follow-up on that too, and that, we think, I think most people look at a budget and they see a bunch of numbers, and the 5-year, again, you've got 5 years worth of numbers, but you have to remember that, a group of people, typically the board and the manager, have sat down and actually thought out, what's going on, operationally, into the future and what might happen, with administrative charges like insurance, for example, or planning for a project or any number of things. So there's a lot of, real planning, that's sort of embedded in behind those numbers. And in some cases, you might even want to go out and borrow, money in order, if you've got a project that you can get done inexpensively today, it might cost a heck of a lot of money tomorrow, and interest rate is only 3%. So anyway, that's my follow-up.
Tracy or Tuan, anything to add?
I mean, financial statements by their nature are somewhat reactive because you're reporting things that have already happened, which is why it feels that way. But yeah, I would reiterate the comments that the budget is really the forward-looking document. And your financial statements, you shouldn't just be waiting until the end of the year to get your statements from your auditor or whoever to see how you've done financially. It's important to be monitoring that, at least on a quarterly basis, but I would suggest a monthly basis, where you're comparing your results to your budget, which was your plan.
Tuan, last words on this issue?
Yeah, just to basically to be proactive from an accounting standpoint, and that was something that we wanted to, I guess, discuss as well, as what the difference between the internal statements and the final audited statements is that on a monthly basis it would be good, be more accurate if accruals are done on a monthly basis to give the board a truer picture of what the expenses may be, rather than not accruing anything, and then at the end of the year the audit gets done and all of a sudden you have an excess of expenses that you didn't see coming, so definitely doing accruals on a monthly basis.
Thanks. Okay, Dre, do we have someone lined up for a live question?
Yes, we do. Next, we have Mark. Go ahead, Mark. Mark, are you there?
There we go.
Perfect.
Can you hear me now?
Yep, you're good to go. Ask your question.
Okay, good. Just a practical question. I guess this would be for Walter. My board is looking at moving towards self-management, but from a management company, and we've been interviewing bookkeeping companies, and we were looking at the handouts, and we're very impressed with the clarity of his monthly management income statement, the way it's laid out and presented. And we showed that to a couple of companies who use standard software packages, and they didn't recognize it as something that they could just generate automatically. Someone suggested it must be done with Excel or something like that, but I just wondered, how is that? Is that a particular statement format something that, as far as you're aware, a bookkeeping software package can produce without any special tweaking?
The example in the handout is an actual that was produced by a property management company, and it's produced by a special purpose let's say bookkeeping / accounting application. So there was no special tweaking that was needed in order to produce it. And as I sit here, I'm running a mind block as to the name of the package. But Mark, I can get back to you and actually give you the name of that package. And
perhaps, Mark, what you could do is put.
John's got his hand up, I see.
Oh, okay.
Yeah, I was going to suggest, Mark, because I did have a similar question in the Q&A, because the condo corp that I'm part of is self-managed, and we use Sage 50 Pro.
Okay.
It's a basic program. It's relatively inexpensive, and it does everything we need. And quite frankly, the auditors that audit our condo corporation are quite happy with what they're provided.
Well, I know that one is used by bookkeepers, but I'm not sure it would produce. Yeah, I would like to know what that package is if Walter can remember it.
So Mark, I'm going to suggest that you send in the chat box and make sure you just send it to all panelists. That'll come to the panel. Send some contact information and we'll get that information to Walter and he can get in contact with you directly after the webinar.
Thank you.
All right. Do we have another question lined up, Andre?
From Don Mitchell. Go ahead, Don.
Yes, I'd like to ask you to think in terms of a unit owner. And our board is reporting that we have our general fund owing our reserve fund approximately $37,000.
Mm-hmm.
And the response from the board is, don't worry, we don't have any financial problems. Is that something a unit owner should be concerned about?
All right, who wants to take that on first? Tuan, do you want to start since you talked about reserve fund and then we'll get the rest of the panel to weigh in?
Yeah, absolutely. No, like I think we've all emphasized that whenever a board or even an owner has questions about your investment, definitely the answer of, yeah, don't worry about it, it's taken care of, is probably not acceptable. It definitely should be investigated to ensure that, you know, that money is properly in the interfund account rather than, you know, being loaned back out to the general fund.
Yeah, I have seen it done on a lot of financial statements where the reserve fund has loaned money to the operating fund. But I agree with Tuan. If somebody answered me with "don't worry about it," I'd be concerned.
Tracy or Walter, anything to add?
The bigger question is, are there funds available to actually eliminate the interfund transfer? Mm-hmm. Like if you have balances owing between funds and the fund that owes the money to the other fund doesn't have any net assets or fund balances or equity in it, then I think, yeah, you have a problem in that scenario.
Yep, I think Tracy nailed it. Exactly. If there's no funds to, you know, to pay for the, you know, for the interfund transfer, then there is a problem, and that could mean that that there will be an increase in condo fees in order to raise enough money in order to clear the you know, the amount owing.
All right, Andre, our next person in line for a question.
I don't have a first name, but I have a last name, Schneider. Go ahead. Oh. Mr. and Mrs. Schneider, there we go.
Yeah, my name is Lorraine, and I think the previous question maybe just answered this. I just wondered if it was normal practice to borrow from the reserve fund, say to pay the insurance premium in full, to not have any administration fees charged to the condo association. And does it have to be reported on the financial statement then as monies being owed from operating to reserve and a declining balance, I would assume, every month on the statements?
Okay, so just make sure we're all clear on the question. The question is, can you take money out of your reserve fund to pay an operating cost such as insurance? Do we all want to say the answer at the same time if I count 1, 2, 3? 1, 2, 3.
We're not answering now.
I can take that one because
okay. Go ahead, Walter.
You know, typically, you know, it gets me to this whole, you know, idea of budgeting. What we've seen, of course, is most budgets, you know, in order to make it easy, you know, you just take the annual budget, divide by 12, and that's your monthlies, right? And that includes your reserve fund contributions. But if you all of a sudden get a huge insurance bill during the year and you're looking to see, well, how am I going to pay for this thing? You can, during the year, just defer your monthly reserve fund contributions, but you have to make sure that by the end of the year, you get them all done. So because the way it works, of course, is you're collecting condo fees every month, which is sufficient to really or depending on the amount of the increase in the insurance, to be able to pay that by the end of the year. But if you're still going to run short, then you end up with that amount owing back to the operating fund. So so what we've done is we've done exactly that. Or what I've seen that done. We've done it in our own corporation. Is just deferred paying in other words, you don't pay your reserve fund contributions for 6 months, and then you double up, let's say, for the last 6 months, or whatever combination you want to do. But make sure that at the end of the year it's all in there, or else you're off your plan. You're off your reserve fund plan.
So from an auditor's perspective, Tracy, what would that do if you saw that in the documents when you're doing your audits? I think the question is talking about money coming out of the reserve fund that's already been put in the reserve fund. Does that raise any alarms for you, Tracy, as an auditor?
Well, again, it's based on, I have seen it done, and it really just, where it gets reflected is in this interfund balance, right? So if there is a balance that still hasn't been fixed by the end of the year, then the next place I would look to is there equity sufficient in the funds at the end of the fiscal year to be able to cover off that interfund balance?
Yeah, and with our condo corporation, we have a similar situation where our insurance comes up early in the fiscal year, and we often don't have enough money in our operating account to pay it, so we will borrow from the reserve fund. But it is definitely paid back within a couple months, 2 or 3 months, and definitely by the end of the year.
All right, anyone else want to add any other comments before we move on to the next question?
Well, I think there's a difference between borrowing from the reserve fund, which is actually moving funds from the reserve fund back to the operating fund, which is not permitted, and just rearranging the let's say the amount that you pay every month into the reserve fund, because really the obligation is to put X amount of money into the reserve fund, so you can put 0 in the first 6 months, and 2 times 0 in the second 6 months, and you haven't borrowed from the reserve fund. You just rearranged the cash flow going into it.
Mm-hmm.
All right. There's a question in the Q&A about, our statement of cash flow statements mandatory? Is that a mandatory statement?
In Ontario, it is, yeah.
Yeah, in Manitoba it is as well.
It's mandatory from our national Canadian standards for MPOs. So if you don't have a cash flow statement in your audited financial statements, then you should have a qualification in your audit report, because it is required. It is required under the standards.
Yep.
Tracy, can you just clarify for everybody what an MPO is?
Oh, sorry, nonprofit organization. Yep.
All right.
Accounting lingo. Sorry.
All right, another question that came in advance of the webinar, a person from Ontario asked, when a condo corporation has a management company, what exactly are the responsibilities of the treasurer of the board? So let's start with Walter on this one, and then go to John, because both of you have been treasurers on condo boards. And so from your perspective, what's the role of the treasurer when there's a management company?
When there is a management company, well, the role of the treasurer is really dictated by 2 things. It's the Condominium Property Act, for the province that you're in. Many of them have actual responsibilities of the board, but not necessarily the treasurer. But then the bylaws will usually, have the roles, the role of the treasurer. And when we teach it in Southern Alberta, quite a bit of the treasurer's role is delegated. And what's typically, and I've got a list here, what's typically delegated to the property manager is opening and closing bank accounts, collecting condo fees, reconciling bank statement, financial record, keeping the financial records of the corporation, the first draft of the budget, and preparing monthly financial reports. So those are typically delegated to the property manager, but usually not delegated, or, for example, maintaining the auditor, banking, and investment advisor relationship. reviewing and supervising the work, of the property manager, financial work of the property manager and the bookkeeper, preparing or overseeing the work of the auditor. It should be the treasurer overseeing the work of the auditor, not the property manager. Developing, the financial aspects of the reserve fund plan, investment policy and strategy, and actually investing surplus funds, and borrowing. All aspects of borrowing, should be on the treasurer's. So that's kind of the way, we teach the segregation between delegated and non-delegated.
John?
Yeah, I agree. The treasurer is the one who is ultimately responsible on the board for the finances of the condo corporation. Now, that being said, that doesn't mean that they have to be involved in doing the daily deposits, checks, or anything else. That can all be done by the property manager. But the treasurer is responsible for those finances and should have close contact with the property manager and understand what the property manager is doing and what the property manager is reporting to the board. And if the property manager is providing monthly statements, the treasurer should be well aware of what's in those statements.
All right. Andre, let's line up the next person we have for a live question.
It's Mr. Karam Huda. He's just coming in. One moment. There we go.
All right, go ahead, Karam.
Hi, my name is Karam from Alberta. I have a question about the presentation. I work for a property management company, and we have a lot of condo board treasurers who want us to follow a certain format of financial statement presentation. And obviously, we can have one kind of format to follow, and we're trying to keep it as close to the financial statement of the auditors. But is there a law that says that the monthly financial statements that are presented should be in a certain format?
Well, I would say in Alberta there is no law about it, but I think there should be. I'll tell you, that's when I first came onto my first condo board, one of the first things I was confronted with was, well, wait a minute, the owners get a budget, and typically the budget was in one format. The annual financial statements were in a different format, and the monthly, reporting was in a third, format. And, so one of the first things I had to do was build a, basically a program, rejig things, in order to make them the same. But one thing that I think is extremely important, boards, are a smaller group of people, they can learn the differences. But for owners, most of whom don't know anything about or are not financially literate, they should at least get the same format, for everything they get from the board. Financial audit, the annual financial statements, should line up then with, certainly the operating and the income statement should line up, so that they can do the comparison. Otherwise, it's apples and oranges. Good question.
Tracy, from a national perspective?
I don't think there's any law that says your internal financial statements have to follow a certain format. But I think it goes back to the general premise that in order for the statements to be useful to the board on a monthly basis, they should be in a format that's understandable to them. And the closer that can kind of mirror, like the financial statements that we presented, that income statement, those are a lot of very general categories. And like repairs and maintenance could have elevator, garbage removal. There's a couple other big categories that are combined. But the more closely related the monthly financial statements are to the final audited statements, the more useful all those things become to the board.
All right. Okay, we're slowly getting to the end of the webinar, so I want to try and get a couple more questions in. Andre, let's take another live question.
We have one coming in from RC Sanati. I'm not sure if I have a first name.
All right, go ahead. You need to unmute yourself. All right, let's bring someone else in, Andre.
Okay, we have...
Oh, I'm here now.
Okay, go ahead. Andre, choose someone else in the meantime. Go ahead.
I apologize. I'm from a small community of it's a small condominium in rural Ontario, and I'm just responding back to a question I heard from Don, and it's regarding interfund deficits. So my question is, how many years can the board hold an interfund deficit to the reserve fund? Also, when the board keeps issuing yearly deficit recoveries and special assessments. And finally, we don't seem to get in our biannual statement periodic information certificates. We don't seem to get our certificates.
All right, Tuan, do you want to talk about that from Ontario's perspective? Oh, you're muted. Okay,
sorry,
go ahead.
I was answering questions on the Q&A. Can you repeat that?
Yeah. Go ahead, repeat your question.
How many years can the board hold an interfund deficit to the reserve fund? Secondly, when the board keeps issuing yearly deficit recoveries and special assessments. And finally, missing periodic information certificates.
All right, so in terms of the interfund balance, our statements, obviously you'll see the interfund balance, but we'll also show that as part of our auditor's report to highlight that. And we try to encourage the board and the manager to clear that up as soon as possible. I don't think there's any rules in our province that's stipulates how long you can carry it for, but we try to tell our clients to try to resolve that in the subsequent year as quick as possible. Your second question
is, the second question is to provide the deficit or to clean up the deficit. How many years can the boards keep creating deficit? Keep creating special assessment and deficit recoveries to counter the interfund. So my point is, if they'll do a deficit recovery 1 year, and they'll show that on the books, and then the next year they'll show a special assessment, but every year the interfund balance keeps staying the same.
Right. So it sounds like the condo the condo fee budget is not high enough if you're always incurring a deficit every year and then also carrying an interfund balance. So, at that point, we would definitely recommend that the condo fee budget be reviewed. And unfortunately, it sounds like there's going to be an increase for future years for condo fees.
All right, let's go. We've got time for one more question. Ellen, I keep trying to. There you go. Go ahead.
Thank you very much, everybody, for this opportunity. So I'm going to read out the question I had in the chat. At the beginning of this form is stated who prepares these financial statements. Is it the property management company or the treasurer? And the second question is, if under legal costs, can a resident's name be stated outright? Is this against the Condo Act? Should the names be redacted?
Okay, we're going to answer the first question. The second question is more of a legal question, which is not really what we're going to be talking about today, but let's deal with the first question.
Sure. I can start with that one. It's really up to the arrangement you have with your property manager as to who prepares the statements. Most of the ones I've seen, property managers are preparing the financial statements and the treasurer isn't. And in self-managed, the treasurer is usually presenting the financial statements or preparing them. But you can have an arrangement with your property manager that the treasurer, if they're qualified and feel capable of doing it, that they can prepare the statements.
All right, anybody else on the panel want to add to that before we wrap things up?
Yeah, I'd just like to comment on that one. Typically, the monthlies are done by the property manager or the accounting department, of the property manager or the bookkeeper if it's a very small operation. one thing many people don't know, with their audited financial statements, is that the auditor doesn't necessarily just audit, financial statements that are already prepared. Typically, they also they will prepare the annual, financial statements from the accounts, of the property manager, and then they will audit, the numbers that are in that statement. But I think many people, and they don't realize that the property manager or that the auditor typically prepares the tax return and the information returns. I think that's lost on a lot of boards, and I think it's something. I'm glad the question came up, because it's something that people should know. Not in all cases, obviously, it depends on what's in your agreement with your property management company, but in what I've seen.
Tracy and Tuan, any last words on this issue?
No, I think that was a good point that Walter made. Like, most of the statements that my clients get are statements that I actually prepared based on the internal statements of the property management company. Because traditionally, the internal statements don't have all the notes to the financial statements and all those types of disclosures that are required.
And Tuan, last words?
No, I'm good with what the other said.
Okay. Well, thank you. I want to thank all of you for joining us tonight. I know it's unfortunate that we can't have these webinars go on for hours and hours, because we still have quite a few hands raised and questions in the Q&A box, and even some questions that we received in advance that we weren't able to get to. But this is an opportunity for you, when you get the survey that goes out after this webinar, to list topics that you would like more webinars on. And it's not necessarily a webinar that National will be putting on, but it could also be something that you would like to see at your local chapter. We'll pass that information on to the chapters, and perhaps your local chapter could put on a webinar about some more specific topics in terms of financial statements that you would like. I'd also like to thank all of our speakers, Tuan, Tracy, Walter, and John. Thanks for coming out tonight and joining us, sharing your knowledge and your experience. It's been a pleasure working with you, and hopefully we can all get you back on a panel again in the future talking about financial statements. I'd also want to just let people know about some upcoming national events. And the big event that's coming up next for National is our national conference, and that is on May 29th. And I just want to show you this video clip from our keynote speaker, who's going to be talking about artificial intelligence in your condo strata. This is definitely going to be a presentation you don't want to miss. Let's just take a listen to see what she's going to be talking about.
Hi, my name is Jennifer, and I'm going to be speaking at the CCI National Spring Conference. I'm going to be talking about artificial intelligence. Artificial intelligence, also known as AI, is sometimes portrayed as really advanced features like the Terminator in that movie. But really, AI has a real opportunity in the condo, strata, and townhouse environment. AI systems tend to take humans and human error and human effort out of functions and decision making. So maybe we use drones to understand roofs and the quality, or understand siding or bricks, and see if we can identify where there may be failures or cracks or issues that need to be addressed that may not be easy to identify by the human eye. Systems collect a lot of data, whether it's plumbing or heating or other types of environments where there's a lot of data and information collected. We can have tools and systems that identify where wear and tear might be happening and do some predictive and preventative maintenance. There's a lot of data that gets collected through board meetings and sharing of information. We can go and collect and analyze that data in a faster, more simple way by using some forms of AI. And last, even things like understanding behaviors and patterns of movements of people, and can we better improve heating and cooling and other types of systems. I'm going to talk about a couple of these examples so that you really understand how AI can be used and how you might want to be careful about using AI. So be sure to join me, cci.ca. Register for May 29th for the National Spring Conference, and I'll see you there.
All right, so that's definitely going to be a topic that you don't want to miss. You probably never thought about artificial intelligence in terms of condos and strata, but we're going to find all about it on May 29th. The other thing that I'd like to show you, this is our national homepage, and on the homepage, if you click on events and upcoming events, you get a list of not only national events, but you get a list of also all the other webinars that our chapters from coast to coast are putting on. And as you can see, in April alone, from now to the end of April, there are 16 events scheduled across the country. So if you're interested in any of these events, just go to cci.ca, click on events, upcoming events, and then click on the event you're interested in, and that will take you directly to the chapter that's hosting that event. Also, I would definitely want to make sure that we don't end today without thanking our sponsors. And as we indicated at the beginning, these webinars, we are able to provide them free of charge to members and non-members across the country. But we're only able to do that because we have the generous support of our sponsors. So thank you once again to our sponsors, Aaliyah Associates, Bridges Property Management, BFL Canada, Condo Genie, and Metro Jet Wash. As I indicated earlier, you will be getting a survey. We do appreciate your feedback, whether it's good or bad feedback, because we definitely want to make sure that these webinars and our conferences are geared to things that you want to know about. So tell us in the survey, and we'll be using that to plan future webinars and events. Our next webinar, national webinar, is on June 9th. And so I hope to either see you at our conference on May 29th or on our next webinar on June 9th. Until next time, I'm Sonia Hodis, and CCI is your condo connection. Thank you, everyone. Have a great evening.